Hi, I'm Hedgeye founder and CEO Keith McCullough. I'm excited to announce the Hedgeye on the Prize tournament. I challenge you to compete in this simulated investing tournament to win some serious money. We'll be awarding weekly and monthly cash prizes along with the big grand prizes. Along the way, we'll teach you how to take your investing to a whole new level. I hope you'll join us. I'll be coaching you every step of the way. I'm Keith McCullough, and welcome back to round 3 with one of my favorites, Liz Ann Sonders. Welcome from Nantucket.
Thank you, Keith. Nice to be here as always.
Yeah.
Sorry it's not in person, as we've done many times before, but this will have to do.
We're starting to get closer, and if that happens, you can't hang out in Nantucket in Florida anymore. Or maybe
you want to bet? This technology doesn't die when everything's fully open again, so we'll see.
That's awesome. Well, congrats on that article, or I think it was called "Songs of Experience: Reminiscence of a Strategist." I'm assuming that was just a bit of a riff on Jesse Livermore, correct?
It was. I mean, the first part of the title was, as I always do, a rock song title, and that was, of course, U2. And then the second part was a riff on the Reminiscences of a Stock Operator, which is one of my favorite books about this business of all time.
I couldn't agree with you more. You and I agree, just to be put on the table, everyone, she and I agree on far too much. So this is not going to be like a backslap.
It's not going to be a debate. Yeah, exactly.
But in terms of approach, we really do. I think we kind of grew up in the business the same way. You're younger than I am, of course. This is your 15th year doing it. And she actually puts in that article how many years she's been doing it. I dare you to guess. But when you get like Marty's WAG, don't fight the tape. I grew up same way at a hedge fund. John Dawson, Art Sandberg was called Dawson Sandberg. As you know, it's you have to, at a very basic level, I think, or you don't have to do anything, let's just be clear, but you and I have always had a keen appreciation for what the market may know that we don't, correct? Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there, subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.
That's right, absolutely. And not only that, I also think that, and one of the first quotes that I put in that report a couple of weeks ago was probably the most famous from Sir John Templeton about bull markets are born in pessimism, grow in skepticism, mature in optimism, die in euphoria. And what I love about that is that it highlights that sentiment, probably more than anything else at major inflection points, is arguably more important than any of the fundamentals we obsess about on a day-to-day basis, whether it's economic data or inflation data, earnings. But then on top of it, even if you have a high conviction sense from a sentiment perspective that we may be at or approaching an inflection point, you need that trend component of it too, or sometimes you can end up being really early to either the beginning of the party or the end of the party.
Yeah, that part of it, I'll struggle with that until I'm on the wrong side of the grass, I think. But just trying to be early or on time, there's a big difference. And I prefer to be on time all the time, but nobody really can do that all the time unless your name is Bernie Madoff. But if you think about it, the positioning sometimes lines up. Like the street, for example, right now, guys, if you can show futures and options contracts, one of the biggest positions people had was basically being long deflation or duration. People were long 10-year notes, they're long dollars. And then you get this massive move in a very short period of time in interest rates. I wonder, so that's my main question for you. Who's got it right? Today is a good day to ask the question because the bond market, a breakout in bond yields, is not signaling the same thing that the stock market is.
So I think it's premature to know who's got it right. You and I have talked about this. I think regardless of the environment, it's important for equity investors to heed the messages coming from the bond market, whether it's the treasury market or corporate spreads. That said, there's certainly speculative positioning can exacerbate moves in a benchmark like the 10-year yield, and I think that to some degree happened into the late March move up to just under 175. I think you got speculators that got caught a little bit flat-footed on the short side and had to cover, and that arguably exacerbated the move back down to 112 or so on an intraday basis. Arguably, that may have overstated what was happening in terms of fundamentals. But I think we're at a little bit of a stall right now as we try to suss out whether we truly are shifting to a very different secular phase in terms of inflation. And we did see very recently the correlation between bond yields and stock prices dip down back into negative territory, which is where we were for the 60s, 70s, 80s into the 90s. And then we shifted to that more deflationary environment. It's maybe too soon to suggest that that correlation having reverted to negative is a signal of a secular shift, but it is certainly at or near the top of the things that I'm paying close attention to.
Yeah, it's especially a tough spot because we had, and tell me if you disagree with this or not. I know what the rate of change data says, so I highly doubt you disagree with me. But did we or did we not peak cyclically in the second quarter and decelerate in the third quarter with the Delta variant, U.S. economy?
So I think there's been a lot that has been directly tied to the Delta variant. I think you see it in a variety of economic data, goods versus services. I think you see it in the market, whether you look at a breakdown between cyclicals and defensives or higher multiple segments of the market versus more, quote, value-oriented segments of the market. I think that absolutely was a shift that occurred. And also, interestingly, and probably not coincidentally, it also came at about the time where we saw a peak in the growth rate of liquidity measures such as money supply and the Fed's balance sheet. We haven't seen a peak in level, but the growth rate started to ease at the end of the first quarter. And I think those are all tied together. And I really think it's been important in this environment of the market having been so resilient, looking under the surface at the churn and leadership changes that I think have been fairly easy to explain by virtue of not just what's going on in the bond market, but to your point, Delta variant and its impact both on the growth side of the equation and the inflation side.
Yeah, that like just so people know what the rate of change did, and like on slide, the year-over-year rate of change on GDP growth on slide 13, you could see it went from 12 to 6. I mean, and on a year-over-year basis. So again, most people knew that was going to happen. I think that I at least was a little surprised at how quickly it started to slow, but then not surprised because I wasn't so surprised by the Delta anymore in terms of the Delta variant. But if you look at slide 44, here's one slide maybe, Lizanne, that explains what, and I want to get your thoughts on this. Obviously, this is like, again, it's the causal factor. COVID went up, consumer confidence went down. You had a bad jobs report, and the services sector, services side of the economy slowed. Like everyone knows that. Bond yields weren't going up while that was happening; they were going down. Then all of a sudden, you get the inverse of that, which is the COVID cases. Next chart, guys, rolled over. They're down 40% week over week. Last week. And my signal here is that all four of those charts back to slide 44, Lizanne, are going to reverse with the inverse of COVID. And that's what I think the bond market's signaling. But I have a lot of people that disagree with that, so feel free to.
Well, so I think there's more to the trajectory of economic data right now than just COVID cases, because I think, although not permanently entrenched, I think the supply chain bottlenecks and disruptions, of course, driven by COVID, aren't going to automatically adjust simply because the rate of change moves toward the better for cases. And I think that's the rub, because it's not only now a story that ties into the inflation narrative, it's actually a story that ties into the growth narrative. Not to mention the fact that associated with a more stringency in parts of the world with regard to any uptick in COVID and the greater willingness and speed with which shutdowns happen, that feeds into the supply chain bottleneck problem that, again, has not just been a feeder into the inflation numbers that we are seeing, but now is acting simply as a constraint on growth. And I don't think the COVID cases rolling over is as big a needle mover there as might have been the case even a few months ago.
Well, a lot of those, the way I think about that is through the lens of inventories, which, when I look at the big components of our GDP or any GDP model. You have the services side, which slowed decisively. That wasn't all bottleneck. That was Delta variant in a lot of different respects, and we have not released the Kraken on those rate of change charts at any level. They're barely positive on a year-over-year basis. But inventories were grossly, not just understated, but they're bottlenecked. It's even on the cover of Barron's, for God's sakes. It's not like nobody knows this. Inventory. So I think of inventory as being that story, whereas I think of the services economy as being the reopening. What do you think?
So I agree with you there, and I think what was miscalculated, I think, when we saw the reopening, and this is several months ago now, is I think some of the more extremely bullish economic views out there, call it the Roaring '20s folks, that view was I think based on an assumption that goods demand would remain really robust and that you would just add to it the pent-up demand on the services side. But what we saw was a bit of pent-down demand on the goods side and a shift to demand on the services side. There's also dislocations that are unique to this pandemic because of the combination of the pandemic shutting down access to services at a time when we saw unprecedented liquidity infusions, both on the monetary and fiscal side. That meant you had a period that was fairly lengthy where you had demand surging. And even though initially supply could meet that, you then have a bit of the opposite right now, supply constraints by virtue of COVID at a time where, at least on the services, we saw that pick up in demand. I think really key to the story, looking beyond the pandemic, if we ever get to a point where we can truly say post-pandemic, will be that relationship between the goods and the services side of the economy. It was our view back many months ago that we were more likely to see an easing in demand on the goods side because so much of that demand had been met. And then I think the inventory piece, to your point, there was certainly a lot of hope when we had the weaker than expected Q2 GDP, given that a lot of that weakness was driven by the inventory component, that we would get the reverse of that in the third quarter. And that has proven to be something that at least has to be pushed out, which is part of the reason why GDP estimates, Atlanta Fed GDP now has gone from over 6% to now only 2.3%. And I think pushing out that inventory rebuild is part of that.
See, my numbers for the first time, when I deviate from the Atlanta Fed, I generally take a position. So if you look, guys, put up slide 14, my quarter over quarter SAR numbers have actually gone up a little bit for the third quarter. And again, or for the fourth quarter. And the fourth quarter, I think the third quarter is priced in. I mean, it's October. It's not even the third quarter anymore. So yeah, I get that people are going to talk about it on the conference calls. Yeah, I get it's on the cover of Barron's. But at any level, if inventories are released in the months of October, any level, we can use something simple like autos, which we're at levels that, slide 55, guys. I mean, it's 88% below the mean. I mean, the normalized mean going back our entire career. I mean, these things aren't going to stay ball underwater forever. So that's one point.
I agree.
And the next point is on this. So the inventory piece to me would be a bonus to my number because it's not taking up my number because we nowcast, right? So our numbers only inventory, if it came in higher or lower, it would just go into my nowcast. But on services, I just can't find a case for Americans not having the biggest Thanksgiving ever in terms of getting back together or rate of change accelerating on slide 58. This is the one. This is what Liz Ann's been talking about. She's she's one of the few people that I could talk to where every word is a time series in her head. It's emblazoned in her head. The baby blue line is what she said is on the right side, which is consumption durables, which ripped and then they rolled over. And then there's the black line, which hasn't done anything yet, which is the consumption services. It's the biggest part of the economy. So I'm betting that's going. I think bond yields are betting basically that's going to be going up for the next 3 to 6 months, and all I need is the next 3. What do you think?
And I think you're right. It's just a question of timing, and that's Rob. The inventory rebuild story is an easy one to tell. What's more difficult is trying to find the point at which we really start to launch, and that's where we go back, not just to the Delta variant, but the virus more broadly. And where the risk lies, as we've learned the hard way over the last year or so, is that whether it's another variant, whether it's news with regard to when you start to see a wearing off of the benefits of the vaccine. There are so many factors at play. You can look at the rate of change in terms of overall cases, and that looks like a really, really powerfully positive chart. But we saw that last year too, when wave 2 started to roll over. And I'm not an epidemiologist, nor am I a Debbie Downer and saying, look out, whatever the name of the next variant, is going to be vaccine resistance, it's going to be bigger. But we're all at the mercy still, sadly, of this virus in terms of those trends, but also just human behavior and consumer sentiment. And so I agree with you. I just don't know that we're imminently there in terms of the timing.
Well, that's why I use the bond market as my signal. Like I was, just to put it on the table, you know how my quads are defined, right? So we went from quad 2, which is peak nirvana, growth and inflation accelerating at the same time in the second quarter, to quad 3, where you get a real growth slowdown. And I got lucky, unfortunately, with the Delta, being something I didn't know was going to happen, and made the numbers slow even faster. But again, the bond market signaled both the up move in bond yields into the second quarter, and it signaled the down move throughout the Delta in the third quarter. And now they just took off again. So to me, first of all, the bond market, it's the fourth quarter. The bond market is not trying to sniff out what happened 3 quarters ago or what's on the cover of Barron's. It's figuring out something. There's only one quad, Lizanne, I backtested it as you know. There's only one quad where interest rates break out to the upside, which is quad 2. And quad 2 is not the Atlanta nowcast, which is another quad 3, right? Because you get real growth slowing is quad 3, real growth accelerating is quad 2. So that's what I'm getting my ass kicked in this position today on parts of the growth side, but on the inflation side, I'm fine. But that's definitely what I'm trying to kind of wrestle with here, because it's day to day. It's like schizophrenic market action. There's a lot of what we call the chop, and chop is where I like to take a position that's against the street.
The chop has been extraordinary. If you look at whether it's a day-to-day or week-to-week, month-to-month basis, just the sector rotations, and there are bedfellows that tend to be paired together on a day. You've got, energy or utilities and energy financials at the top of the leaderboard. You can almost be guaranteed that tech and comm services are going to be at the bottom, and vice versa. And the swings have been rapid fire. And there are times you can directly tie it to the COVID trends, other times the move in the 10-year yield. And I'm not sure we get out of that environment anytime soon. What's interesting, though, is under the surface, if you look at factors as opposed to sectors, or in particular as opposed to traditional style indexes, there's this quality theme or override that has been a pretty consistent leadership factor, regardless of whether you're screening for quality within more value-oriented sectors or more growth-oriented sectors. And I think taking more of that factor approach, at least in the near term, probably still makes more sense than trying to pick a sector or two that is going to be a consistent outperformer.
Yeah, well, I break all that down daily, weekly, monthly, trending or not. And it is interesting too, like if you just, and again, it's only a 1 week move, but last week during the stock market correction, high beta, high leverage and small cap all outperformed for the first time in forever in a down week, right? That's different than quad 3, which is, to your point, quality work throughout the third quarter. But if that flips, which is basically led by energy to the upside because it's levered and it's high beta, then that would be a problem for Wall Street. And again, it would be much like the problem they had missing quad 2 the last time, because what happens after that is factor exposures like high short interest start to rip you, the wrong way. And to me, it's just really interesting to watch. I mean, you and I have a competitor, Mike Wilson, he's long defensives. Well, if you were long defensives, which would be sectors like consumer staples, utilities last week, you got crushed. I mean, that's not what the gold, long-term bonds going down. That's not how a quad 3 or, God forbid, a quad 4. When we say defensives, like you and I have no problem going to defensives for a long time.
Well, the thing about labels like defensives or even labels like momentum, I think what trips up investors is a misunderstanding that with a characteristic or a factor like defensives, it doesn't always mean consumer staples and utilities.
Yeah, exactly.
During the worst part of the pandemic last year, the defensives were the big five. They were They were Microsoft, Apple, Amazon, Google, and Facebook, not your classic defensives, but in an environment where everything is shut down and the only ecosystems in which we're living were tied to stocks like that. That was the pandemic era's defensives. In turn, utilities live in the value indexes. That doesn't mean they're always value stocks. In aggregate, they're more expensive than the S&P. That doesn't mean they're growth stocks. It just means they're expensive stocks that live in the value indexes. So that goes back to what I meant about you can, particularly if you're a stock picker, you can screen for certain characteristics or factors without putting blinders on as to where you look for them. And I think the whole, in particular, growth value discussion never goes deep enough. And when I hear somebody say just growth or value, my question that always pops in my head is, well, what are you talking about? Are you talking about the growth and value indexes? And even if you are, just look at the vast differences in terms of sector and industry exposure across whether it's the three major growth indexes, S&P, Russell 1, Russell 2, same with the value index. There's twice as much tech exposure in S&P growth and Russell 1 growth as there is in Russell 2 growth, where there's twice as much healthcare exposure in Russell 2 growth. And you get the same big divergences in areas like financials with the value indexes. So I often talk about growth and value, but it's mostly in the context of the fundamentals of growth and value, not the predetermined index labels associated with that.
I think that's totally old wall, like, growth value, and just keep saying it, or 60-40, saying it and saying it and saying it. It's like, come on, let's get up to speed with the modern game and the modern day analytics. I mean, guys, can you show our factor exposure table that I was just calling out? Should have some purple arrows on it. I mean, when I'm saying that high, the high debt to enterprise value trade and or high beta moved last week. I mean, that's what the numbers are doing. So back to Marty Zweig's point, which don't fight the tape. I mean, if you get that to continue, that's going to be new. That's how I do it, Lizanne. I don't care about anything else, as you know. Like, I literally say, okay, bond yields is happening, and that starts happening, then that's telling me we're not going into the end of the world. We're about to reopen the economy, and it could be back to the quad 2 trade. So we'll see. If that reverses as of today, then I'll say the opposite tomorrow. So it doesn't, like, you don't. What do you think about that? Because a lot of people obviously think I have a lot of issues, me included. Because I really don't care what I buy or sell. I'll short what I was long. I'll buy what I was short, and that's just the way that I am. I'm just going to use what the market's doing as my lead navigator, as opposed to what I have. I'm not an intellect. I don't need to be an intellectual about what's going to happen that isn't happening. I have a tough enough time with what is happening.
Here's where you and I differ, not in terms of our approach or in belief. I think if in my world there was more of a goal to kind of be right at the right time with not extreme decisions around positioning, but that is your job, especially tied to your constituents, your client base. I think it's a very different world from my perch at Schwab with now $7.7 trillion in almost exclusively individual investor money. And there always, I think, needs to be underlying the message that somebody like me imparts, which will be high conviction at times and express a view in general on market direction without trying to be the perfect market timer, because that is not an approach that individual investors, for the most part, should take. I always say, that one of the more common questions I get from traditional financial media, especially when the market goes into a more volatile phase, is, okay, Lizanne, are you telling your investors to get in or get out? And I have a love-hate relationship with that question, because I hate it because I think it's a dumb question, but I love it because I get to explain why I think it's a dumb question, which typically starts with neither get in nor get out is an investing strategy. That's simply gambling on moments in time, and you have to be right twice. And I think for individual investors, the most important message is that it's not what you know, meaning about what's going to happen in the next month or 2 months or week or even quarter with regard to what the market's going to do, that matters. It's what we do throughout the process. And so I think there's a subtle difference, especially relative to maybe somebody like a Mike Wilson, somebody at one of the traditional investment banking wirehouse firms that maybe has more of an institutional audience and gets involved in the competition around year-end price targets. And we just take, I think importantly so, given our client base, just a different approach that ties into what actually are the pillars of success for individual investors. And trying to time the market is always difficult, but when approaching it with an all or nothing, all in, all out, back up the truck, dump the truck, I think that's where you can really trip up individual investors.
Yeah, for me, it's about making quad pivots. So it's, I like to think that no matter what your, whoever you are, institution or an individual, you'd prefer to be on the right side of the cycle than say that you can't time that. I mean, cycles are absolutely timable, not by everybody, but in hindsight, you can always look back and say, okay, that's where growth slowed, that's where it accelerated. So, I think it's a fair goal to get up every morning trying to time the cycle using the market signal. What's interesting about what you just said too is that it's there. What Zweig would say, and what I think Charles Schwab himself would say, which is you can't time markets. Those things don't always go together. Right? I mean, how do you say that don't fight the market if it's a signal, and at the same time say that that's not a signal or it's not a timing signal? You see what I'm saying?
Well, it's a question of what the sort of subsequent, say, asset allocation recommendation is. Even at a moment like in late 2007, that I had a very, very high conviction view that what was happening was a literal and figurative house of cards. What then the message is, I think, differs depending on who the client is, who the audience is. Even if I were talking to, at any point in time, if I had the highest conviction view on, say, both the equity market and the bond market, yet sitting across from me were two investors. Investor A is, 22 years old. They just inherited $10 million. They don't need the money. They're not going to obsess over every wiggle in the portfolio. They're big. They go bungee jumping and skydiving on the weekends. They don't need to earn income. And then investor B is 75 years old, has a nest egg that they built over decades, can't afford to lose any of the principal, and need to live off the income. So one view on the market, what I would tell those two investors is entirely different. So I think that's really the point behind the way maybe we approach things a bit differently than some that are not thinking in the context of, well, who is the investor?
Yeah, well, it's always the toughest thing. I mean, when you have so many different people and so many different goals. I mean, that's why I always go back to just execute on your process, and let everyone do with your process what they want to do with it, right? If I'm right on quad 2 and you want to be wrong on the 10-year yield all the way up to 175, and do that. That's totally up to you. But it's not like I'm not saying, and I think we're both actually. I think you're around 170, 175 on the 10-year, aren't you? Or
well, we don't do forecasting on that kind of stuff.
Me, that's just going back to where we were. So it'd be just a mean reversion to where the 10-year yield went during quad 2. So that's it's like you'd like to know that if we get real rates rising, that's bad for gold. You should know that, right? There's no case to be made that real rates rising is good for gold. There never has been. So that's what I think about that. How about we get some other people's questions, because I have too many for you. And last time with Ben Hunt, you know what I did, Lizanne? I didn't forget. I just kept asking him questions, and then we didn't have time for.
And you never got to Q&A for other people.
With you, I was just trying to figure out.
Ben always generates a great roster of questions. I'm a big fan of his.
Oh, he's awesome, isn't he? That guy.
Yeah, he is. He's awesome.
He's such a good guy.
He is.
He can be so, like I said, you could be so angry about something, but you smile when you say it.
Yep. Yeah.
It's so good.
His temperament is well suited to this business.
I think, he literally reminds me of, like, if I was talking to Ben Franklin instead of Ben Hunt, that's what it would be like. It's
good analogy.
Encyclopedic and everything. All right, here's a good question. Tim in St. Louis, is it possible, Lizanne, to invest long-term anymore in such U.S. markets where price discovery has been rendered obsolete? Now, that's his opinion, but...
So I actually think, if anything, some of the shorter term forces, whether it's price discovery caused by or exacerbated by central bank policy or the vagaries of the COVID cycle, if anything, I think lengthening time horizons will serve you better than dramatically shortening them and then trying to play the shorter term game because of how many forces exist outside of what historical forces have been, whether it's high frequency trading, the new advent of what Reddit fueled retail day traders are doing. So I absolutely still believe in long time horizons. In an environment where over the past 40 years or so, you've gone from double digit years in terms of the average holding period down to single digit months. I think that pendulum arguably swung too far toward the short term, which, a short term trader isn't going to adopt that view. But I think long term investors ought to be comfortable in a longer term time horizon, because I think over any reasonably longer time horizon, there is a more definitive connection between fundamentals and prices. It's part of the reason why valuation is a terrible market timing tool, regardless of what metric you look at. There's no correlation between any version of PE and subsequent, 6 or 12-month returns. But you start to extend that out over a 10-year period of time, and that's where the messaging is a little more consistent with subsequent performance.
Yeah, the quads explain valuation much more succinctly than the valuation explaining the cycle. I mean, if you're Quad 3 stagflation in the 1970s, which I want to get your thoughts on next. I should have asked you this anyway. But if we were to have pervasive stagflation, like the 1970s, the S&P 500 went to 7 times earnings. Let's just start there. That would be a pervasive Quad 3. That's what I'm mostly concerned about here for my own positioning, Lizanne, is that I basically, and I took my time like I should, I didn't like all or none it, but started taking out some of my Quad 3 stagflation longs, stayed with all my inflation longs, and got a little growthier, a little bit more cyclical into the Quad 2 push. But over time, it's pretty easy to see a longer term stagflation if the Fed comes in and bails things out and takes the dollar back down. What do you think about that?
So I don't think we are yet sowing a sufficient number of seeds to suggest a systemic wage price spiral 70s style version of stagflation. Right. I think there are still more differences in the current environment than similarities. Yes, you can simply look at the trajectory of growth expectations versus inflation and say we're in a stagflation environment. But what we had in the 1970s, aside from the wage and price controls, there was the psychology and power associated with the spiral that meant what became systemic in terms of workers' demands for higher wages, companies' willingness to pass on those higher costs. There was greater unionization. There was less globalization. It was much more of a closed economy. The Bretton Woods. I mean, there's so many factors at play. It gives you a checklist to keep an eye on for the medium to longer term to see whether we are planting some of those seeds. For now, though, I don't think that represents a significant risk, not to mention the huge difference in productivity. I think that's probably the most important component of math that is a big difference now versus the period of 1970s. And if there's any silver lining to this pandemic that we've been living with, as I think it's provided actually a boost to productivity that will be long lasting. So for now, those are the things I'm hanging my hat on with regard to whether we're entering that kind of environment. But again, I also I know what the checklist should be to see whether maybe the landscape is changing.
No, that was, that was encyclopedic. It embedded in her comments were time series as far back as you can go on all the things that really matter. It's not the 1970s, but the word stagflation. When I say Quad 3, I'm always going to say stagflation, but there are very different kinds of stagflation. The stagflation that China's having right now versus what was defined as Quad 3 in the USA, which was just a rate of change slowdown with inflation spiking in the third quarter in the U.S. On that productivity point, I should have asked you about this as well. I thought one of the least reported numbers last week, or at least talked about by people that you and I compete with, was the capex number. I mean, the capex number, I look at everything on a 2-year basis, so I'm not just caught in a 1-year base effect right now. And capex accelerated on a 2-year basis to 8.5% versus the prior month. And that, to me, that's an investable story.
And that's where my optimism is greatest when I think beyond the sort of vagaries of the COVID era. Is I think we are going to see an economy that shifts more than just marginally toward the investment side, and maybe by default slightly away from the discretionary consumption side of our economy, certainly boosted by the demand piece, the consumption that was driven by all the stimulus that we talked about, especially when things were shut down, funneled toward the good side of the economy. We did see, as of second quarter, consumer spending get to more than 70% of GDP. I don't think that falters significantly, but I think as time goes on, we're going to see the investment side of the economy, both on the residential and non-residential side, business capex, and then possibly with a kicker if something ever passes out of Washington on the infrastructure piece. And I think it's across segments of the economy, not just tech-oriented, efficiency-oriented, which has been the bright spot, even when capex has not been a terribly compelling story. But I think across the spectrum of infrastructure, education, healthcare, residential investment, even the kind of rethink about commercial investment. And that's, to me, one of the longer term, most optimistic stories about some of the shifts that are occurring in our economy.
Yeah, if you just look at, guys, put up slide 54, where we are in the inventory cycle. It's a great time to be investing in having capacity. I mean, that chart's never going to be that low for the rest of our lives, Lizanne. That is.
And if you look at the age, I don't know if you have a chart of just the age of a lot of structures, more traditional segments of infrastructure. I mean, most of this stuff is older than me, which is beyond middle age. Let's just put it that way.
Come on. Well, it was
unless I'm gonna live to well over 100.
All right, next question. This one is from he's got the second most upvote, so I'm going to ask it. It's not accurate in terms of what it says entirely, but I'll ask it anyway. He said he believes that last time Lizanne was on that you thought we were going to go from, in my vernacular, quad 2 to quad 3 and he says instead of like Hedgeye was calling for quad 4. That's not true. We were calling for, it said quad 4, and we're saying that the probability was rising of quad 3, and it ended up being quad 3. And we're on the right side of that, thankfully. But does she see a quad 3? This is a good question. Do you see that the most likely outcome for 2022 being stagflation, quad 3, or deflation, quad 4? Pick a quad. I mean, what do you think it's going to be?
It could even be an environment where it's both, if some of these supply chain bottlenecks maintain that sort of upward pressure on traditional inflation metrics and a still wide spread between measures like PPI and CPI, that could carry into 2022. I think whether it's the number of container ships sitting off the ports, the fact that even though there are plants that are starting to come online, new plants in terms of semiconductors, a lot of the estimates for when that problem starts to unclog continue to get pushed out into the second part of 2022. So I think the next year could be a year that has both of those stories.
Yeah, I do too. I think quad 4 by the middle of next year is well, against those base effects, it's a mathematical certainty. It's just whether or not markets interpreted it as much. The toughest base effects in the history of base effects. What could possibly go wrong? And now that everybody's a base effect. Yeah, now everybody talks base effects.
Everybody talks about base effects. I no longer feel compelled to explain the term. If you haven't heard it, I'd love to know what lovely rock you've been living on, because it's a happy place where we don't worry about stuff like that.
The best is the Fed. Like, they understand base effects, but they don't understand how to use them. So that's even better. Against steepening base effects, let me help you. Against steepening base effects, inflation continues to accelerate. That's a problem. All right, Dave in California. Lizanne, this is a great question. Lizanne, you recently wrote that piece reflecting on your career. Broadly, what's one of the biggest differences between investing today versus when you started?
Oh my gosh, there's so many. First of all, I touched on the time horizon piece, the average holding period. And you can look at different metrics that will focus on holding period for individual stocks versus, say, for mutual funds, more recently, of course, ETFs, but a dramatic shortening. But also, I think the biggest difference is just how democratized I say collectively, we, the broad industry, but I would certainly credit to a great degree somebody like Chuck Schwab himself for, I think, launching that process of democratizing investing and bringing costs down and access up and giving investors a much wider berth in terms of the ability to call it more of an endowment approach and have diversification, not just be limited to stocks, bonds, and cash. I think that's been the biggest difference from when I was starting. And then just the access to information, the access to education. I think there's, limited excuse for not taking advantage of that greater source of information and education. There's also a lot of noise that's come along with it, and that sometimes is tricky to navigate through that noise. But there's never been a better time in terms of access to information, access to investment vehicles and strategies at a cost that is a fraction of what it was 35 years ago when I started in this business.
Yeah, there was nothing. There wasn't even the internet. So let's just like the but now
Photron was the and it was messages were on those little. This was even before your time, Keith. Was on those little pink pads where you had to write out, to and from and time. And if your office got a call at 6:00 at night, you didn't get the message until the next day when you got in. And it really is remarkable, the technology change. You're right.
My first day as an intern on Tiger Williams' trading desk, he'd given me an internship there, and I had to write out, punch them, but black tickets were buys and red tickets were shorts, and that's how I hashtag timestamp. That's what I thought of the timestamp. Now it's
I would analyze company earnings by looking at I forget, I think it was the third section of the Wall Street Journal, and that's where you got earnings information. Again, there was no internet. I think our kids' generation can't even fathom a world with no internet, let alone voicemail and cell phones. It's really incredible.
Yeah. All right. Here's a good question from Mike in Connecticut. I personally, this is actually a tough one. If you can't time markets, Lizanne, or rely consistently on negative correlations, how do you advise drawdown adverse clients to survive the next major market correction? Do they use stops?
I think there are various strategies that individual investors can employ, and it depends on what the overall structure of the portfolio is, how broadly diversified it is, whether from a turnover perspective, tax implication perspective, it's appropriate to use, whether it's stop loss points, whether some hedging can be done in the options market. The one, I think, overarching strategy that is maybe more brilliant than a lot of other traditional disciplines is periodic rebalancing. And I think there are times, especially when you start to see elevated volatility and you see more rapid fire sector rotations or even factor rotations, if you let portfolio volatility be your guide to the periodicity of rebalancing, of course, it forces us to know what we know we're supposed to do, which is not so much buy low, sell high, if that infers all in, all out, but add low, trim high, and stay in gear by using volatility to your advantage. And I think for a lot of more trading oriented folks that don't have a plan, they tend to do the opposite. They let their winners run until it becomes an outsized portion of the portfolio when the inevitable Ben Graham reversion to the mean happens, you're left holding a bigger bag than you would have otherwise if you just heed the discipline associated with rebalancing. So I think the timing around rebalancing and maybe considering less calendar-based static rebalancing and more portfolio volatility-based rebalancing can sometimes help weather an environment where risks go up, as does volatility.
Yeah, we use what we call it's a volatility adjusted risk range of the market. So at the top end of the range, you sell some. At the bottom end of the range, you buy some. If you keep doing that, if you have the hardest thing to do is have the discipline to do that, because to your point, behaviorally people are risk averse. So at the low end of the range, they're scared to buy. At the top end of the range, they're reluctant to sell. If you actually just do it with Bitcoin, we've taught a lot of people how to do it with Bitcoin. I know nothing about Bitcoin, but I'm long Bitcoin. And all I do is do that. So at the low end of the range, I buy some, top end of the range, sell some. And then I don't have to.
Honestly, I think that should in particular be applied to some of the more speculative segments of the market. And I think that's one of the things that has made a year like this incredibly unique, because there has been a lot of focus, including by me, on some extreme signs of kind of speculative overdrive. It just has been more concentrated in non-traditional segments of the market, whether it's crypto or SPACs or non-profitable tech or heavily shorted stocks or, penny sheet stocks, zombie companies, bankruptcy stocks, whatever subcategory you want to talk about. And so when I hear the market has been incredibly resilient, aside from the churn under the surface, which we already talked about, many of those aforementioned spec areas have had drawdowns this year of 30, 40, 50, 60, in some cases. If you look at the meme stocks, 70 or 80% drawdowns. So this idea that the market has been completely resilient to these spikes in sort of speculative froth suggests you need to look beyond just a benchmark closing index like the S&P 500.
Yeah, again, look at everything on a volatility adjusted basis instead of the simple moving average of things, because it's the particular move in volatility that catches people offside, as Benoit Mandelbrot would teach people. It's not the average of things, it's the particular things. So this was in particular a great discussion. So thank you for making some time for us.
My pleasure. I always enjoy it, Keith. Thanks so much.
Awesome. She's Lizanne Sonders, and I'm Keith McCullough, and I'm signing off for today. We're going to be back tomorrow with 3 more real conversations. Thank you.